$14 billion. That's the volume of forced selling about to hit the precious metals market in less than 48 hours. Not a rumor, not speculation, a mathematical certainty. Two major banks have confirmed it. Scotia Bank has quantified it, and the Bloomberg Commodity Index must execute it. But here's what they're not telling you. This isn't about silver crashing. It's about what happens when $14 billion in paper metal collides with a physical market that's already sold out. The question isn't whether Friday arrives. The question is whether you'll be positioned before it does. Welcome to Currency Alert. If you've seen a few decades of markets, made a few financial decisions in your time, then you know that wisdom isn't about chasing excitement. It's about recognizing patterns before they repeat. Hit that subscribe button, not because everyone else is doing it, but because you understand the value of being informed before the crowd catches on. And tell us in the comments of where in the world are you watching this from today. On a typical Wednesday morning in January 2026, silver traders around the world witnessed something remarkable. The price of silver climbed to $82.75 per ounce, nearly touching an all-time record high. For a brief moment, it seemed like the metal was unstoppable. Then Thursday arrived, and the correction began. Most investors saw this as normal profit-taking, a healthy pullback after a strong rally, but experienced market analysts knew something else was coming, something bigger, something that had nothing to do with normal market behavior. The silver price was now trading around $78 per ounce. It was consolidating within a clear pattern, an orange triangle on the daily charts that technical traders recognized immediately. This pattern had appeared before. Back when silver was bouncing around $50, the same consolidation happened. When that pattern broke, silver exploded from $54 all the way to $83. So the setup looked perfect for another massive rally. The bull market remained intact. The trend was still pointing upward. Everything suggested that once this consolidation ended, triple-digit silver was next. But then the news started circulating. A premium article from Zero Hedge appeared with a headline that made traders pause. Is silver about to crash? Why two banks think a meltdown looms next week? The article was behind a paywall, but the damage was already done. The rumor spread across trading desks and social media. Screenshots were shared. Analysts started digging deeper. What they discovered was not a prediction. It was a scheduled event. The Bloomberg Commodity Index, known in financial circles as BCOM, was preparing for its annual rebalancing. This wasn't discretionary trading. This wasn't about market sentiment or economic forecasts. This was structural, mathematical, unavoidable. Here's how it works. Every year, commodity indices must rebalance their holdings. They have target allocations for each commodity they track. When something goes up significantly over the course of a year, their actual holdings exceed those targets. The math is simple. If an index is supposed to hold 10% of its portfolio in silver, but silver doubles in price, suddenly that allocation is far above 10%. They have to sell, not because they want to, not because they think silver is overvalued, but because the index rules require it. Scotia Bank released a detailed analysis of what was coming. The numbers were precise. BCOM would need to sell $7.1 billion worth of silver. They would also need to sell $7 billion worth of gold. Combined, that represented over $14 billion in selling pressure hitting the precious metals market over just 5 trading days. The selling was scheduled to begin after the market close on Thursday. That meant Friday morning would likely see the impact. For silver specifically, the numbers were staggering. The forced selling represented approximately 17% of the total open interest in March futures contracts. That's not a small number. That's not something the market could easily absorb without price movement. But here's what made this different from typical selling pressure. This was forced selling, structural selling, the kind that cannot be priced in beforehand. When markets know about a potential event, they usually adjust prices ahead of time. It's called buying the rumor, selling the fact. Traders anticipate the event and position themselves accordingly. But that only works when the selling is discretionary, when traders can choose their timing. This was different. BCOM didn't care about chart patterns. They didn't look at resistance levels or support zones. They didn't check the RSI or the MACD indicators. They had a mathematical requirement to rebalance, and they would execute it regardless of market conditions. The selling would happen over 5 days, starting Friday. But there was another layer to this situation that most people missed. BCOM doesn't hold physical silver bars. They don't have vaults filled with actual metal. What they hold are paper derivatives, futures contracts, positions in ETFs, financial instruments that track silver's price, but aren't actually silver. This distinction was critical. Because while $14 billion in paper silver was about to flood the market, the physical silver market was experiencing something completely different. It was running out of supply. Major online dealers were showing sold-out signs across their inventory pages. The 100-ounce silver bars that serious stackers prefer, mostly unavailable. When they were available, they were listed as pre-sales with shipping dates pushed weeks into February. One dealer was selling 100-ounce Scottsdale bars on pre-sale, delivery scheduled for February 13th. That's over a month away. The premiums told the real story. Physical 100-ounce bars were trading at approximately $85 per ounce, while the paper spot price sat at $78. That's a $7 premium, nearly 9% above spot. So here was the situation heading into Friday. $14 billion in paper metal about to hit the market. Physical metal already scarce and trading at significant premiums. And a price consolidation pattern that looked ready to break higher. The question wasn't whether the selling would happen. The question was what would happen when it did. There's a peculiar phenomenon happening in the silver market that most casual observers completely miss. Two markets, same metal, entirely different realities. In the paper market, traders move billions of dollars with a few keystrokes. Contracts change hands in milliseconds. Prices flash across screens in real time. It's fast. It's liquid. It's abstract. In the physical market, dealers are telling customers to wait 4 weeks for delivery. This disconnect reveals something profound about how modern commodity markets actually function. And it is this disconnect that makes Friday's $14 billion sell-off far more complex than simple supply and demand mathematics would suggest. Consider what's happening right now across major bullion dealers. A buyer visits a popular online precious metals site. They navigate to the 100-ounce silver bar section, the product category that serious investors prefer. Page after page shows the same status. Sold out. Pre-sale. Back-ordered. One listing catches attention. A 100-ounce Scottsdale silver bar. Available, but with a caveat. This is an inventory sitting in a warehouse ready to ship. This is a pre-sale. The estimated shipping date? February 13th. That's over 5 weeks away from the time of purchase. Why would a dealer offer pre-sales with such extended timelines? Because they know the metal is coming, but they don't have it yet. The refineries are backed up. The supply chain is stretched. The physical demand is overwhelming current production capacity. And here's where it gets interesting. These same 100-ounce bars, when they are available for immediate delivery, are priced around $85 per ounce. But the funnel's a spot price that everyone watches on financial news networks shows 78. That's a 7 gap. A 9% premium over the supposedly real price. So which price is real? The paper price that moves instantly, or the physical price that reflects actual transaction costs? The answer reveals a fundamental truth about precious metals markets. They're not one market. They're two markets running in parallel, usually correlated, but increasingly divergent. Now consider what BCom actually holds in their index. They don't own physical bars sitting in a vault somewhere. They hold futures contracts on exchanges. They hold positions in exchange-traded funds. They hold derivatives, financial instruments, whose value is derived from silver's price, but which are not themselves silver. When BCom sells $7.1 billion worth of silver exposure, they're selling these paper instruments. They're closing futures positions. They're liquidating ETF shares. They're unwinding derivative contracts. Not a single physical ounce changes hands in this transaction. Yet the paper price will move, because futures markets determine the spot price that everyone references. The price discovery mechanism runs through these derivative markets, not through physical transactions. This creates an unusual opportunity structure. When paper prices fall due to forced selling, physical premiums often rise to compensate. The dealers know that physical supply is tight. They know that buyers are waiting for dips. So when spot drops from $78 to $75, they might simply adjust their premiums upward, keeping the actual out-the-door price relatively stable. The stacker who thinks they're getting a bargain at 75 spot might find that premiums have jumped from 7 to 10. Their actual purchase price? Still $85, but there's one category of silver where this dynamic breaks down. Constitutional silver, the old US coins minted before 1965 that contain 90% silver, dimes, quarters, half dollars, what the industry calls junk silver. Right now, these coins are trading at spot price, no premium, sometimes even a slight discount. Why? Because you can't easily convert them into the standard forms that industrial users or large institutions need. A solar panel manufacturer can't use mercury dimes. An ETF can't hold walking liberty half dollars. These coins require refining, melting down, processing, before they become the 999 fine silver that modern markets demand. And right now, refineries are completely backed up. They're running at capacity trying to convert whatever secondary silver they can get their hands on into standard bars and rounds. The backlog is weeks long. The time and energy required to process constitutional silver makes it less desirable in a tight market. For the strategic buyer, this creates a specific opportunity. While everyone else is fighting over 100-ounce bars with massive premiums and month-long delivery delays, constitutional silver sits available at spot price, ready for immediate delivery. It's the same silver content, the same intrinsic value, but priced as if the supply crunch doesn't exist. Now back to the technical picture. The daily chart shows silver consolidating in that orange triangle pattern. The 4-hour chart reveals something else. The RSI, the relative strength index that measures momentum, has cooled significantly from the overbought levels seen when silver spiked to $83. This cooling period is exactly what typically precedes the next major move. The question is direction. The bulls see support holding at $78. They see the triangle pattern as a continuation formation. They remember what happened after the last consolidation at $50, an explosive rally to $83. The bears see $14 billion in forced selling coming. They see potential support tests at $75, maybe $70. They see short-term volatility overwhelming the longer-term trend. Both might be right. Because in a market where paper and physical are diverging, where forced selling meets supply constraints, where derivatives move billions while dealers can't source metal, the outcome depends entirely on which market you're watching, and which market ultimately proves to be real. While traders fixate on Friday's technical event, a very different story is unfolding across multiple continents, one that has nothing to do with index rebalancing, one that won't end in 5 days. Tuesday afternoon, the Atlantic Ocean, a Russian-flagged oil tanker cutting through international waters. It had been running for weeks, evading pursuit, carrying Venezuelan crude in violation of sanctions. Then, American naval forces closed in. They boarded the vessel. International maritime law, the centuries-old conventions that govern behavior on the high seas, was effectively ignored. The tanker was seized, the crew detained. The message was clear. To most people watching the evening news, this was just another sanctions enforcement story. Another headline in the ongoing conflict between Western powers and nations challenging the dollar-based system. To precious metals analysts, it was something else entirely. It was confirmation that the geopolitical risk premium wasn't priced in nearly enough. Because when nations start seizing each other's commercial vessels in international waters, when the rules-based order begins breaking down at sea, the implications cascade far beyond that single tanker. Supply chains reroute, insurance premiums spike, trade relationships fracture, and most critically, nations start questioning whether holding their reserves in dollars or dollar-denominated assets is actually safe. The same day the tanker was seized, an entirely different threat emerged from Tehran. Iran's army chief issued a public statement, not the usual diplomatic rhetoric, a specific threat. If the Trump administration follows through on its warnings about Iranian treatment of protesters, if Israel escalates its posture, Iran would consider preemptive military strikes. This wasn't new territory. The pattern had repeated for years. Rhetoric escalates. A missile strike happens. Maybe a drone attack. Then tensions cool for a few months. Then the cycle repeats. But each cycle escalates slightly higher than the last. Each time, the window for de-escalation closes a little more. Each time, the risk of miscalculation grows. Each time, the probability that this becomes a sustained regional conflict instead of a contained incident increases. And markets, oddly, keep treating this as background noise. The oil market certainly isn't pricing in major Middle East conflict. West Texas intermediate crude sits at $56 per barrel. Silver trades at $78 per ounce. That means right now, an ounce of silver costs more than a barrel of oil. This ratio is historically unusual, not unprecedented, but rare enough that it signals a major dislocation. Either silver is overvalued relative to oil, or oil is severely undervalued relative to silver. Most analysts betting on the latter. Because if the Middle East genuinely destabilizes, if the Strait of Hormuz faces disruption, if regional conflict expands beyond the current limited engagements, oil doesn't stay at $56. It potentially doubles, maybe more. And when oil spikes, everything else follows. Transportation costs rise, manufacturing costs increase, inflation accelerates. Central banks face an impossible choice: raise rates into a weakening economy, or let inflation run hot. History suggests they choose the latter. Speaking of weakening economies, the November jobs data released this week showed something concerning. Job openings in the United States fell to their lowest level in over a year. Not a catastrophic drop, not a crisis signal, but a clear indication that the labor market is cooling. The U.S. national debt counter now displays a number most people can't even conceptualize. $38.58 trillion, that's trillion with a T. The interest payments on that debt alone now exceed the entire defense budget. For an industrial metal like silver, weakening economic data would normally be bearish. Less industrial activity means less demand for silver in manufacturing, less silver needed for electronics, for solar panels, for automotive applications. But silver's industrial demand has a unique characteristic. It's relatively inelastic. Companies building AI data centers don't stop construction because GDP growth slows by half a percentage point. Solar panel manufacturers don't halt production because job openings declined. The transition to renewable energy, the expansion of artificial intelligence infrastructure, these are multi-decade trends that continue regardless of short-term economic fluctuations. So weaker economic data doesn't threaten silver's industrial demand floor. But it does guarantee something else, more Federal Reserve intervention. The CME FedWatch tool provides a fascinating window into what markets currently expect. It aggregates futures market pricing to show probability distributions for future interest rate levels. Looking at December 2026, most market participants are pricing in 2 rate cuts. That's 50 basis points total, taking the current rate from 3.75% down to 3.25% by year end. That's the consensus view. 2 modest cuts, gradual normalization. But look at what's not priced in. Jerome Powell's term as Federal Reserve Chairman ends later this year. President Trump has already stated publicly that he wants significantly lower interest rates. He's criticized Powell repeatedly for not cutting rates faster or deeper. Who replaces Powell? Likely someone far more accommodative. Someone willing to cut rates more aggressively. Someone Trump specifically selects for that purpose. Then there's the Treasury Purchase Program. In December, the Fed quietly announced they would resume purchasing Treasury securities. Not emergency quantities, not quantitative easing by name, but purchases nonetheless. That program expands, it always does, because here's the mathematical reality. The US government is running trillion-dollar deficits. Someone has to buy all that debt. Foreign buyers are reducing their Treasury holdings. China's been a net seller for years. Japan's facing its own fiscal pressures. That leaves one buyer of last resort, the Federal Reserve itself, which means more money creation, more currency debasement, more reasons to hold hard assets instead of paper promises. The market isn't pricing this in yet. The consensus still expects just 2 rate cuts. Modest accommodation, business as usual. But the combination of weakening economic data, geopolitical escalation, unsustainable debt levels, and an incoming Fed chairman selected specifically to run easier monetary policy. That doesn't result in 2 rate cuts. That results in a monetary environment where precious metals become essential, not optional. And Friday's forced selling? In this context, it's not a reason to sell. It's the last good entry point before the crowd figures this out. Step back from the daily charts. Ignore Friday's headline event for a moment. Look at what's actually happening across decades, not days. There's a pattern emerging in silver that hasn't been seen since the 1980s. Not a short-term trading pattern, a generational structural shift. On the monthly chart, the one that most traders never bother examining, silver has completed something remarkable. A massive cup and handle formation that began forming 45 years ago. In 1980, silver briefly touched $50 per ounce during the Hunt Brothers saga. Then it collapsed. It spent the next 20 years in decline, bottoming around $4 in the early 2000s. Then began the slow climb back. The 2011 rally took silver back toward $50. Close, but not quite. Then another decline, another consolidation. Years of sideways movement while the cup formation completed. Then 2024 happened, the breakout. The handle formed and broke upward. And now, silver trades above $78, having decisively broken through resistance levels that held for decades. This isn't a pattern that reverses because of a 5-day rebalancing event. This is structural, generational, the kind of setup that defines investment opportunities once every few decades. But there's another chart that tells an even more compelling story. The gold to silver ratio, the number of silver ounces required to buy 1 ounce of gold. In April 2025, this ratio stood above 100. It took more than 100 ounces of silver to equal the value of 1 ounce of gold. Historically elevated, statistically extreme. Then something shifted. Over the next 9 months, the ratio collapsed, not gradually, aggressively. By January 2026, the ratio had fallen below 60. Silver was outperforming gold by a massive margin. This kind of ratio compression doesn't happen randomly. It happens when silver transitions from being viewed primarily as a monetary metal to being recognized as both a monetary metal and a critical industrial commodity facing supply constraints. The technical indicators suggest this compression has further to run. The chart pattern points lower, much lower. If the ratio returns to the levels seen in 2011, we're talking about a ratio in the 30s or 40s. If it somehow approached the natural geological ratio of silver to gold in the Earth's crust, roughly 15 to 1, the implications for silver's price would be extraordinary. But let's stay grounded in observable data rather than speculation. The M2 money supply chart provides that grounding. M2 measures the total amount of currency and liquid deposits in the financial system. It's a proxy for how much money has been created. And when you compare M2 to the price of silver, the ratio reveals something disturbing. On a logarithmic chart, The M2 to silver ratio is falling off a cliff, meaning silver's price is rising, but nowhere near as fast as the money supply has expanded. Even at $78 per ounce, silver hasn't caught up to where it was relative to the money supply in 2011. To match that ratio, silver would need to exceed $100 per ounce. And compared to 1980, when adjusted for money supply expansion since then, silver would need to trade above $700 per ounce to match that historical ratio. Now, will silver actually reach $700? That's not a prediction anyone can make with certainty. But the point is clear. Relative to the amount of currency that's been created, silver remains historically undervalued, even at $78, even after the recent rally, even at what feels like high prices to those who remember $15 silver just a few years ago. This is why Friday's potential sell-off matters so little in the larger context. A temporary dip of 5%, 10%, even 15%, against a backdrop of multi-decade undervaluation and structural supply constraints, isn't a reason to exit positions. It's a reason to add to them. But here's what markets aren't pricing in yet. The Federal Reserve projections show 2 rate cuts. Maybe 3 if economic data weakens significantly. That's the consensus. That's what's reflected in current precious metals prices. But look at the actual trajectory. Powell leaves, a more dovish chairman arrives. Deficits continue expanding. Geopolitical tensions escalate. Energy prices spike. Inflation resurges. And suddenly, those 2 projected rate cuts become 4, then 6, then an entirely different monetary policy regime. When that realization hits markets, when the crowd figures out that the amount of monetary debasement coming far exceeds what's currently priced in, precious metals don't gradually adjust. They gap higher, and the opportunity to accumulate at these levels, at $78 silver, at $2,800 gold, that opportunity closes. This is the strategic framework that sophisticated buyers understand. They're not trying to time every dip and rally. They're not trading around Friday's forced selling event. They're accumulating hard assets before the monetary reality becomes obvious to everyone else. Because here's the ultimate truth about precious metals in a fiat currency system. The question was never whether currencies would be debased. They always are. The question was only the pace and scale, and every indicator, from debt levels to geopolitical fragmentation to commodity supply constraints to demographic pressures, suggests the pace is accelerating. Silver at $78 isn't expensive in that context. It's still early. The correction to $78 that happened this week, in a year, people will barely remember it happened. They'll be asking why they didn't buy more when silver was only $78. Just like people asked in 2024 why they didn't buy more when silver was only $24. The pattern repeats. The fundamentals compound. The opportunity narrows. Friday arrives. The forced selling happens. Maybe silver drops to $75, maybe $72. Maybe it doesn't drop at all and simply absorbs the selling. It doesn't matter. Because the traders watching 5-day events will miss what the strategists see across 5-decade charts. This isn't a silver rally. This is a currency crisis, playing out in slow motion, visible only to those willing to look beyond the next headline. And for those who see it, Friday isn't a threat. It's the opportunity they've been waiting for.